Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of ZANA Investments, Tim Little. And on today's show, we have with us Axel Ragnarsson. Axel is an active real estate investor and is based in Boston, Massachusetts. He purchased his first multifamily property during his sophomore year in college, leading to the founding of his real estate investment firm, Aligned Real Estate Partners. Currently, Aligned Real Estate Partners either directly owns or has a GP interest in over 450 units of multifamily real estate and has been a principal party in over 62 million worth of real estate transactions. Axel, welcome to the show.
Thanks for having me. It's a pleasure.
Yeah, and it is great to have you here. So, I give everyone a very high level overview of your background, but on this show, we really like to get into the details on how you got started on your journey to multifamily millions. So, please tell us a little bit more about yourself and what brought you into the multifamily space.
Yeah, absolutely. So, the spark notes in terms of the early backstory is I'm born and raised in New Hampshire. So I've always lived in the Northeast. As you mentioned, I currently live down in Boston, which is about an hour south of where I grew up in New Hampshire. And parents were business owners. They ran a business that manufactured wood chippers. So nothing to do with real estate, bit of a different business, but I was exposed to entrepreneurship kind of at an early age. And I was the stereotypical kid that was always doing anything except trying to get a job to make some money. So I was flipping electronics on eBay and buying and selling stuff on Craigslist. So I was always making money outside of kind of punching a clock. And basically, throughout middle school, high school, was doing that. Tail into high school, early college, I was buying cars. So I'd find used cars on Craigslist and I'd buy and sell them to make money. And I remember at that time thinking, like, there's got to be what comes next? Because this is not the forever plan by any means. And while I was in school, I knew that getting a job wasn't really going to be like my path. It's just every job I had, I lasted a couple of days before I ended up just quitting and going back to doing what I was doing on the side. So I think one day I Googled, like, what do wealthy people buy and sell to make money, or something just extraordinarily vague. And stumbled across real estate investing, and specifically flipping homes. That's the strategy that I first discovered underneath the real estate investing umbrella. So as I started learning more about real estate and flipping houses, and I got my license at this time because I figured, why not? Let me go get my license. That seems to be a good thing to do. I discovered rental real estate and multifamily real estate, the whole concept of passive income and all of that. And I remember just getting really intrigued by that concept. I said, that seems to be a little bit more of a compelling opportunity. You kind of do the work once, find the deal, fix it up, and then you get paid in perpetuity versus you buy it, sell it, and then you got to go do it again. So I started figuring out how I could go out there and buy rental property. It was my early 20s. I had not a lot of money, no credit, no tax returns, and basically tried to solve the problems of where do I find deals and where do I find money. And then I started buying deals, tail into college, and then went full time after that. And spent the first few years in the business growing my own personal portfolio and leveraging a lot of creative financing strategies and doing a lot of different things to minimize my cash out of pocket to do so. And like I said, did that for the first 3-4 years in real estate. And then I wanted to scale and start doing larger deals, and realized I needed to bring in other people to help me do that. So, and that brings us to around 2020, the last couple of years. And in the last couple of years, started to get serious about raising investors, partnering with other investors. And we started doing some larger deals, both in the local market, which is New Hampshire, and then in some other markets around the country as well, specifically Florida, where we do a lot of other business. And now, in terms of what the business looks like today, it's a full-fledged syndication firm in terms of the types of deals that we typically do. We raise capital from investors, and we also co-invest. We go out there and buy value-add multifamily deals, and we fix them up, improve the communities for everybody living there, and everybody gets compensated for doing so. And that's basically the lead up to where we are today.
Yeah, that's really interesting because your story is similar in some ways to other folks that I've talked to, but it also sounds like it varies greatly in the sense that you were kind of all in on real estate from the get-go, starting with
hmm
the flipping houses, which is again that the progression is pretty common, but so often people have their regular jobs while they're doing those things. But it sounds like you went all in from the beginning. Is that the case?
Yeah, pretty much. I mean, I did flip two houses, right? That's my house flipping experience was two homes. So the first property I ever bought was a 3 unit, small multifamily property. But at the time, I was still looking at opportunities to go out there and flip houses. And I did one, made a couple bucks, was moderately successful. Then I bought another rental and then another rental. And then my fifth, I think it was my fifth deal being in real estate was a house flip. And it went so completely sideways that it almost sent me to past zero in terms of just being in debt with no assets going to zero. And I remember thinking at the time, like, I'm just never going to do this again. And there was a lot of lessons learned on it. But the spark notes were that I wasn't a great manager of renovation projects. And that when you're flipping houses, you got to be local, you got to be babysitting GCs, you got to be really involved. And at the end of the day, there's very little margin for error in terms of it's hard to get bailed out, right? I mean, unless the market is appreciating while you're doing it and you can sell it for more than it's pretty thin and the risk is very high comparatively to rental property, for example, where you go in there and you're fixing up some units, maybe you're increasing the rents, but usually the scope of work is a little bit smaller and it's a little bit more straightforward and simple in terms of what you're doing. And there's income along the way, right? In the most fundamental standpoint. So never did one after that. And then it was just all multifamily after that. And this was all kind of in the first 12 to 18 months I was in real estate. But very early on, I was like, you know what? I want to grow a portfolio. That's my path. I don't want to do the transactional type deals in business. And definitely shifted my focus after that.
Yeah, and that makes sense. And I think it hits on a point that a lot of people don't realize when they first start looking at investing in real estate. A lot of people start with the flipping thing just because it's so ubiquitous on social media and television and everything else. So it's like, oh, I could do that. As people are sitting back, drinking a beer, you watching television, but they quickly realize that because, like you said, the level of involvement is so the level of oversight that needs to be done for all the aspects of it. And then the fact that it's so intensive that it, by all accounts, basically becomes a job because you have to continue doing it in order to continually have income. And so once people realize that, I'd say most either get burnt out or they just transition into either just buy and hold on single family properties or buy and hold on small multifamily, or they start to look at that syndication side of the house because they see some of the benefits there. So in terms of that deal that went south, can you give me some of the details on that? Because everyone loves hearing about a train crash, right? We probably learn the most from our failures than we do from our successes.
Absolutely. No, and I mean, I'm happy to share it because it was an expensive lesson, but it was a worthwhile lesson because I didn't make the same mistakes in the future. And basically the deal was I bought it at a foreclosure auction. And foreclosure auctions, you can't really walk the property, right? You go out and you look at it from the outside, you peek in the windows and you hope for the best. And great neighborhood, great exterior, didn't need anything on the outside. But when I bought it and walked in there, there's just way more wrong with it than I had originally anticipated. So my renovation budget, the day I closed, was out of date. And I under budgeted for the renovations. That was the first thing. Was I got into something that I didn't really have complete confidence in. The second piece of it was the GC that I hired to work on it was the same GC that had done very simple cosmetic unit turns for me. And this was a house flip that was being sold to a retail with a stainless granite kind of kitchen finish. Basically, the renovation was much nicer than what this GC had done in the past and the other stuff that I had done. So I hired the wrong GC in terms of their skill set to do that work. And a lot of the work wasn't great and needed to be done over. And then on another note, he had a bunch of personal issues. He hired everyone that was working under him in terms of his in-house staff and then the subs he was bringing in to complete some of the trades related work. They were all trash and all the work was garbage and we had to start over with a new contractor 6 months into the project. So we have all the holding costs with hard money and all this. And one thing after another, I mean, it was just, I think if I'm going to say, kind of summarize what I learned in one thing, it was I bit off way more than I could chew from a project scope standpoint at that time in my career with the resources I had at my disposal, with the cash that I had at my disposal. And I was running a project that I hadn't really done before. And now what we do is if I'm getting into a deal or a market that I've never bought in or I don't have experience in, I partner with people that have experience with that type of deal in that market. I just don't leave things to chance in terms of I'm learning on the fly. I'm not interested in doing that anymore because there's just too many things that can go wrong. And that was just the story of it, right? It was just I like to describe it as, I didn't think I could go wrong, right? I was like, oh, this is a killer deal, great neighborhood, like simple scope of work. I can manage it. And, a little too trusting of the wrong people, a little too trusting of my own ability to manage a project of that size, and definitely a little too close to the sun, long story short.
Yeah, and again, you touched on some really important points that I think are just as applicable to the multifamily space when it comes to hiring the right people or partnering with the right people. On the hiring side,
Hmm.
it's when you're talking about either that contractor or especially that property manager. Both of those are, excuse me, huge when it comes to whether that business plan is going to come together in the end or not, because they can make or break your deal. And then on the partnering side, recognizing what your strengths are or the strengths of others and partnering so that you can rely on those strengths and really leverage them to increase the chance of those deals becoming more successful. So I think that makes a lot of sense.
Hmm. Absolutely.
And then you hit on another piece, which I think a lot of like the passive investors don't really understand, and that is the risk associated with these different types of deals. You said when you're flipping, it's higher risk, right? Because that's your credit on the line, that it's all on you. But when you're dealing with multifamily, I think what a lot of people don't realize is that we have this thing called non-recourse loans, and it's almost counterintuitive in the sense that I bought a triplex before, right? Like I had to use my own money and the bank's going to come after me if I didn't pay the mortgage on that small multifamily. But if I'm doing a million plus larger multifamily, 5 units and up, I'm most likely going to get a non-recourse loan to where the bank isn't going to take my house, my car, my dog. They're just going to take the apartment back because it's a business. It's a business that makes money, and that's what they want. That they don't need to come after my house. So as long as I'm not doing anything illegal, what we call bad boy carve outs, then all those general partners should be safe. And I think that a lot of passive investors, like I said, may not understand that nuance, that the risk is significantly lower, at least for people going to jail, getting foreclosed on, the folks that they're dealing with, anyways.
Hmm. Yeah, I mean, it's interesting because, like you mentioned, it seems counterintuitive. Like they want our personal guarantees on these smaller loans that you would just assume, right? Common sense, lower risk, lower dollar amount, right? But then when they get to the larger dollar amount, they're okay with non-recourse, typically that $1 million loan balance plus. What I found to be interesting about that is it kind of coincides with, I think, a lot of the reasons people really like multifamily, especially large multifamily, is there are the level of individuals that are typically either managing the deals, involved in the deals, lending on the deals, doing the legal work for the deals is just higher, right? The caliber of people is typically higher. And if you're a bank and you're thinking about, all right, I got to go take back possession of this asset that I lent on, it's significantly more painful, at least from an administrative standpoint and from a management standpoint, to go and figure out how to operate that 4 unit deal that's worth like 500 grand or whatever it is, than, the one that's 100 units that's worth, I don't know, $10 million, because you can go find a really sophisticated management company to look after that, right? And you can find other really sophisticated individuals to become involved in that deal because the numbers are bigger, because the pie is larger. And at least in the conversations I've had with lenders, right, that's how they describe it to me, is that it's typically they can right that ship, at least internally, a little bit more easily. Maybe not from a timeline perspective, but at least from the quality of the people that are working on it. But it is an interesting dynamic for sure.
Yeah, and I hadn't really thought about it that way, but that does make a lot of sense. I've never had a lender kind of lay it out for me like that. So, what did your first multifamily syndication look like in terms of how did you get into that? Because there's always this point where people, that jump to multifamily syndication seems almost too high for the people who want to do that transition. They see it and maybe they passively invest, but they don't understand how it's possible to jump up to doing it.
Yeah, and I like to say, I like to preach, walk before you run. If you're like an active investor out there who's looking to go syndicate a deal, like you better have the track record of doing your own deals with your own capital, or maybe a partner or two, durable amount of them, so that you're reducing the execution risk on the deals in which you're raising capital, right? And I think that's a really important component of it all. And I probably bought 100 units personally, just my own resources, my own money, just me, before I ever partnered with anyone at all. And it was a huge mental hurdle for me to partner with somebody else or to raise capital, because I just never wanted somebody else. Like, I was always optimizing for stress mitigation. Like, I don't want to have to work with somebody else and answer to somebody else. And then eventually you realize you just have to do that if you want to scale. But the first few deals I did true syndications, in the sense that we were doing like a 506B or C with a PPM. We did some simple JVs with a couple of partners. We did a 16 unit and a 28 unit down in Florida that were a handful of investors, 3, 4, 5 people in an operating agreement that were all relatively active. And that was a great little segue for me personally, because again, I wanted to take those baby steps, because this was a big intimidating hurdle for me, is raising money. So I just wanted to get comfortable with working with other people in a joint venture capacity and a simple partnership capacity. And those deals went really, really. And then I got pretty comfortable with the whole model of syndication, got comfortable with my ability to execute for investors. And I had a very lengthy track record of success on my own. And the first one I did was I raised some capital for other people's syndications, which, yeah, I guess I can count that. But the first true deal that I led personally as an operator was a 48 unit down in Florida, in Bartow, Florida, south of Orlando. And that was a 506B. Went out there, raised the money. I'm the sole operator on it, sole GP. And that was what I would consider to be my first true syndication, as someone that's going from finding the deal to raising the capital to putting all the docs together to leading it. And what I found was that, to be frank, I got to get better at raising money because I was coming off of a few deals that are these simple joint venture deals where I had a few of the larger investors I work with that were participating in them. And I just went out there and I raised less than I thought I could, but it was fine because I personally could make up the shortfall. Like, I was never really worried about it because I would just personally invest the money. But you really need to, like, you have to continually pulse your investor list throughout the year and try and get a sense of how large it is, how active it is, et cetera, so that you're not left holding the bag when you do a deal. And luckily on that deal, like I said, I only fund whatever the shortfall was, so I was never really concerned about it. But that was a big learning lesson for me, was there has to be more attention paid to that, because at the end of the day, your experience, your track record, like your close network, isn't really going to be what drives the results into the future. You really have to get out there and generate those investor leads and build your list, which is something that I place more of a focus on now. But that was probably the big takeaway in that first one.
Yeah, and a lot of great lessons in there. One, I'm impressed by the fact that you were even able to do a syndication as the sole GP. It's just something I so rarely see. We're always talking about how this is a team sport, and that includes on the sponsor, the GP side too, where there's always partnering going on. So it's pretty surprising to hear that you were able to take down even a 48 unit by yourself. But I definitely can relate to what you're talking about needing to get better at raising money, right? Because this is about always, like you said, having those touch points with investors, because life doesn't stop based on when you have a deal. And so that timing element really comes into play. Like, hey, I got a deal for you. You got 50, 100,000. They're like, oh, sorry, I hadn't heard from you in 6 months. So I just invested in this deal last week that I heard about. So, I mean, some of it you can't help, right? It's just when they need to deploy that capital. But the other piece is maintaining that relationship, keeping it warm, understanding what their needs are. That way you can come to them with a deal that makes sense. Because as we know, different investors have different goals. Some are looking for the cash flow. Others are looking for the long-term hold with great returns at the ends. And if you can identify that stuff and make sure you're having those touch points, and then be able to immediately contact those people, say, hey, I have a deal that's perfect for you, then it's just going to increase the likelihood of, one, getting that money, but two, doing them a favor too, right? Because that's why we're doing this. We're offering them opportunities to do something that's, I would argue, safer and has better returns than, say, the stock market, especially now.
Yeah, and it's interesting that you say that, because I'm sure other people had this challenge, right? But it was like by far the biggest challenge. I had not even, and there's not even any other close, like second, third, fourth. It's like the challenge of reframing the mindset of, when I'm going out there and raising capital, these people aren't doing me a favor by investing in my deal. I'm providing them an opportunity. That simple shift was so challenging for me. I don't know why, but it was just, I didn't raise money for years and years and years. I had people looking to invest and this and that, but I just never felt comfortable because I liked asking people to invest. So it was, and I could, on that first deal I did, every conversation I had, even though I loved the deal, it was a killer deal, direct to seller, we're buying it below market, all these different things. I could sense in the conversations that like, there wasn't a conviction there when I would have these conversations with people that could potentially be interested. And you have to get that dialed in before you can have any success at all raising money because it is a little contagious. So it's something that I'm still struggling with that I'm getting better at now. But I think that's really tough. I think especially for people that maybe don't come from like either a background in either the financial industry or a background where they have close friends and family that have money, right? A lot of my people I was raising money for were just younger folks in my personal network, right? And I was doing a 506B, and it's not like we're taking people's last 50 grand here, but there was like an element of like, I really, really want to make sure that this is like such a no brainer that this conversation is easy, right? But it'll never really be easy. You're always going to be uncomfortable. And I think that was the challenge I had more so than any technical part of making the deal happen, if that makes sense. The deal wasn't the problem. The legal docs weren't the problem. It closed in a timely fashion. All that stuff was great. It was just being comfortable with having all those conversations.
No, you're absolutely right. I mean, first of all, the idea was intimidating to me
Yeah.
because being a steward of people's money, that's a huge responsibility and not one I take lightly, right? But then the other side is like you said, the mindset and having to shift that to not I'm asking people to invest in my deal, I'm offering people the opportunity to invest in this deal. And it sounds very simple on the surface, but mentally it is hard to make that shift.
Yeah.
So
And it completely changes your business, especially if your background in real estate is I do my own deals and I've built my own portfolio. When you start raising money from other people, it's literally not the same business anymore. You've become a service business for other folks. And it's important to be mindful of that distinction.
yeah, and I think that's a great segue into the name of your business itself. You know, it's called Aligned Real Estate Partners. Can you talk a little bit about where that name came from?
Yeah. So fundamentally for me, when I started raising money, the biggest goal for me was creating deal structures that aligned incentives across the board. And we charge some fees. Any investor that's in the business of raising capital has to charge some kind of fees, right? In order to hire people, in order to create a sustainable business at that level, which then actually provides a better service to investors. So I'm wary of the investors that are like, we just don't charge any fees because it's more of a small operation that may hit some challenges if things get rough. So we do charge fees, but less than market. We align incentives with our pref and with our promote structure, where the vast majority of our compensation comes via the promote. And then we also align our incentives down the chain with our PM companies, with our residents, at every single level along the way. And up in New Hampshire, we're vertically integrated. So we own our own property management company and we manage all our own stuff. And have plenty of incentive structures built in with our managers in order to achieve certain hurdles. We're starting to hire internally at the Aligned Real Estate Partners level, and hires that we're bringing in. Compensation is structured in a bonus incentive way, to where there's equity in deals plus salary. So we incentivize at that level. And my entire fundamental mission, at least in the investment, thinking strictly about the investment side of the business, is every single stakeholder from GP to LP to management company is being somewhere in there between PM and the aligned level down to residents. At every level, we want everybody to be aligned in terms of the incentives and how we measure success. So that was the nexus for the name. And there's other things that we're probably going to take in other ways in the future, right? We want to create a more charitable component to the business, which we're trying to launch by the end of the year, called Aligned Giving, where we commit a percentage of the GP of deals to charitable causes. So we can take it in a lot of different ways, but the fundamental thesis is all incentives have to be aligned in order for successful deals to become the norm.
Wow, yeah, and I think on first look, most people would assume, okay, he wants to show alignment of interest with his investors. That makes sense. But what you really talked about, it goes much bigger and broader than that. It's all the stakeholders that are involved with that deal, whether it be the contractors, your own staff, the investors themselves. You want to create alignment of interest with all of those folks and the proper incentives so that everyone benefits, it sounds like.
Yeah, absolutely. I think it started with aligning the incentives between the sponsor and the limited partners, excuse me. But that's just one component of it, right? I mean, there's so many other people that a general partner, a real estate investor is working with and interacting with on a regular basis, especially when you start to grow your team. And that's really in the last couple of months, we started to grow our internal team, bringing on salaried folks within the aligned real estate partners business to help us grow and to help manage our current assets and everything like that. And you can extrapolate how important it is to align the incentives between all stakeholders that are actually rolling up to drive the business's success. And that's how I think about it is I really want to work with folks that are incentivized to drive the mission forward versus I'm just earning a salary and I'm punching a clock, or I'm just a PM company. I'm just charging our monthly fee, or just our level, right? Just charging fees that maybe move our incentives away from really hitting our promote and driving results at the business plan level. And that's obviously something that we want to avoid. So components to it, but yeah.
Yeah, and so you talked about how you've really scaled and how you've become vertically integrated with your business. And it sounds like you've grown pretty quickly. What do you think have been the keys to rapidly growing your portfolio and your business overall?
Yeah. So I think I'll break this question into two parts. I'm going to talk about me personally growing my own real estate portfolio, to start. And the first thing, like by far, the most important thing that an investor can do if they want to grow more quickly is buy deals below market value, like the day that you close. It so drastically supercharges everything else that happens after that fact that it should be really the only focus for any real estate investor that's trying to grow their portfolio. And as you grow, your focus shifts to building your team, raising capital, et cetera. But early on, that is by far the most important thing. All the deals that I did my first 3, 4 years in the business, like I was buying 20 to 30% below market value. And granted, these were smaller deals, stuff that was 5 to 20 units in size, right? Kind of small multifamily. But was doing a ton of direct to seller marketing, ton of cold calling, ton of email prospecting. I had numerous folks that were helping me do all of those different things. I really invested in marketing and built just a robust off market deal pipeline. And when you're finding deals below market value, you open up a lot of more creative financing opportunities to bring slightly less of your own cash to the table so that you can really make your dollars stretch. And that was like a must for me. If I looked at a deal that was maybe worth $1 million, right? And I could buy it for 900. Most people would say, yeah, that's not bad. Let's go out there and do that deal. I was like, no, I need it for 750 or 8 because I need to pull my cash out in a short period of time so I can continue growing the portfolio. So that was step one. And then after that, hey, we're trying to grow the business here a little bit, right? We're trying to create some infrastructure. I brought in people to help me with that very early. Like I was quick to outsource, whether that was working with A's or part-time employees or just getting things off my plate, vendors. I got bookkeeping off my plate very quickly, got property management off my plate very quickly, got content creation off my plate, very, very quickly. I never sourced my own debt. I was always working with a mortgage broker. Like I was always trying to bring my focus back to finding good deals. And that was what I was just trying to be really hyper focused on. And now that focus has evolved to I'm investing in the business at like a salary W-2 level, probably much sooner than I should, honestly. I know I made some hires sooner than everybody else I know in this business in terms of when they made hires, but I constantly want to keep buying back my time, building the infrastructure for a business that can actually scale and hit more of a hockey stick growth trajectory. And I want to spend all my time now. It's raising capital is a real needle moving activity for me because we're finding deals without as much of my direct involvement. But I think that's how the evolution has seen. It was a relentless focus on deals, and now it's become a relentless focus on delegating and elevating and building a really, really high quality team that allows us to hit our next stage of growth.
Yeah, and that totally makes sense to me. And just in terms of the how much more productive you can be as you delegate. Like I'm an army officer, right? Like there's no way we can do everything ourselves, nor should we. And so it
Mhm.
is a must that you delegate to those people who are the respective experts within their positions, and you trust what they're doing, but you also come over their shoulder and check to make sure that everything's going the way it should be. I'm curious to know what was the first salaried position that you did hire for your business? Because it sounds fairly recent. And like you said, I think that's the next level of growth where a lot of operators are not sure what that first position should be and at what point in their business they should make that hire?
Yeah, so the sequence from a hire standpoint. So earlier this year, January of 2020, I hired a full-time virtual assistant 40 hours a week. I had a part-time VA for probably the year before that, but then I brought her on full-time, right? She wanted to go full-time. It was good timing. So brought her on full-time, really helping with a lot of content related work, admin related work, brainstorming, written articles, blog content, all these different various tasks, right? All the one-off stuff that we deal with on a regular basis. Um, Second hire in terms of salaried, like US based, was a director of acquisitions. And that was somebody to help us go direct to seller because we still do a lot of these small to mid-sized deals in New Hampshire because it's just very low hanging fruit for our business. So to manage our direct mail, our email prospecting, our cold calling, and then also to underwrite inbound deals that we were receiving from brokers or other investors, potential joint venture partners, et cetera, salary plus commission role. And then the real big one in terms of like a kind of a month to month salaried commitment was director of operations. I made that hire in early September, so a couple months ago. And that individual, his name's Ivan, he's focusing on asset management of our existing assets, transaction coordination on deals that we get under contract, building out our internal systems and processes so that we can actually manage all of the deals that we're doing. Because at any given time, we probably have 7 to 10 deals that we're either buying, selling, or under contract on, because we do a lot of smaller stuff in conjunction with the larger stuff that we pursue. So there's just like a high volume of paperwork and keeping all of that under control and managed and tracked is important. So I like to say he takes things from contract to close. So I'm involved with our director of acquisitions, getting stuff under contract. I help raise the money throughout that period, but he's spearheading due diligence, organizing debt, doing everything on that front. He takes it. We're both involved in asset management, but he really drives that on a week to week basis. And then he's on the back end, building out everything we need to from an organization standpoint as a business to manage all of this. So we have 3 full-time folks, one virtually in the Philippines and then 2 US based. And yeah, it's still growing. So ideally we could add to the team next year at some point if the business allows for it.
Yeah, that's great. It sounds like those folks, even if it is still a little early for their entry into those positions, I think what you're doing is you're building that foundation, that infrastructure that will be necessary for you to continue to scale up. So when that does happen, you're not like bumbling around trying to make it happen and fit the pieces in. It'll make growth that much quicker because you already have the infrastructure in place, the processes, all that stuff. So I think it's really smart. And as long as you can afford it and it makes sense from a budgetary standpoint, then, absolutely the best place to invest is back in your business.
Yeah. And I'm in my late 20s, right? I don't have kids. So all this stuff, like I can live pretty inexpensively. So for me, I don't take a lot of money out of the business, right? I'd rather pour it into the business and delay that gratification a little bit, right? And just having one full-time person in your business, like 10x is what your business can produce. It's pretty crazy. And I've already started to see that in terms of the results that I'm being able to deliver by taking some of my folks away from more of the administrative related work. And the results are incredible. So I highly urge everybody listening, if you feel like you're on the cusp of being able to afford someone and you feel like you're not getting everything on your to-do list done every day and you're leaving productivity on the table, like I highly recommend at least bringing somebody in at some level, right? Even if it's part-time. I mean, it's game changing.
Yeah, and I think that's true probably not just for active syndicators with 600 units. That might be just as applicable for that busy professional who has so many things that they want to get done but can't because as soon as they get off from their job at the end of the day, maybe they're making dinner, they're playing with the kids. And so hiring, like you said, even like a virtual assistant to take care of the minutia that they don't have the time or desire to deal with may free them up to have more time to look at investments or to spend time with their family or whatever the case may be. Because I mean, I know in a lot of respects, that's one thing that we're trying to do for busy professionals too, right? Is free up their time so that they don't have to be in there swinging a hammer, doing a reno on a property that they own. Because so many do, they know that real estate is a good investment. And so they buy a couple of houses here and there. But then at a certain point, they're like, man, I got 3 or 5 houses and this is taking up way more of my time than I want or care to give. There has to be a better way. And we're able to say, yeah, there is. And you don't have to worry about the tenants, the toilets, all that stuff. So we give them the time back because we're doing the due diligence, we're implementing the business plan. And so I think that's a really attractive option for those folks who don't want to be as actively involved in their investing as maybe they once were when they were 20 something years old and had all the time and energy of the world, didn't have the kids, the house, everything else that was vying for their attention.
Completely agree with all that. Yeah, I mean, I think everybody has opportunities to buy their time back. It's just doing a time audit and seeing where you're spending time, where you either A, don't enjoy what you're spending time on, or B, where you're like, hey, it probably makes sense for somebody else to be doing this, so I can focus on X, whatever the results driving activity is. And it's a good periodic activity to do every couple of months, like analyze what you're spending your time on.
Yeah, I couldn't agree more. Well, hey, this is amazing conversation, but we do have to transition into the turbo round. All right, so Axel, I'm going to ask you 3 questions that I ask all my guests, and I just want you to give me a quick, honest answer. The first question is, what is one red flag every investor should look out for? And that could be either a passive or active investor.
So just doing business with people who haven't yet done what they're about to do. And I kind of touched on that earlier in the episode, but like, if somebody out there is pitching you a self-storage deal, but they're a multifamily investor, I'm not even opening the email. Like, it's pretty straightforward. And I'll just share a quick thing, like the Startup Incubator Y Combinator. I don't know if you're familiar with it or not, Tim, but it's a Silicon Valley, right? They go out there, invest in companies and help incubate startups. Their number one predictor of success is domain expertise. It's like, have you done what you're about to do in this field? Yes, no. That's the number one driver or potential driver of success in terms of how they analyze deals. So it should be the same for us as investors. Don't buy something you don't know how to do. Don't invest with someone who hasn't done what they're about to do.
Yeah, and I certainly agree that expertise grows over time, and you can't have shiny object syndrome and as an investor and be all over the place and think that you're going to grow that expertise. I think it does become tricky when you want to broaden the aperture a little bit. And so maybe you started out in multifamily, but you see this amazing student housing. And you're like, well, that's close enough. And that might be okay, as long as, to your previous point, you're partnering with someone who's an expert in the field and they're based on the ground where this asset is. So you're able to bring in skills that are still applicable, but you're relying on the strengths of that other person to provide you the segue into that new asset type.
Exactly. That's exactly what I would have said. And then on the next one, right after that deal, you've got the experience on that one, and now you can go do the next one, right? But that's the playbook, basically what you just described. That's perfect.
Awesome. Okay, the next question. What is a myth about this business that you would like to set straight?
Oh, geez. That it's passive? It's not passive unless you're a passive investor, right? You're an active investor. I think a lot of people think that it's more passive than it is, especially folks that are newer to the game, right? Newer to real estate. Our 48 unit deal, we're on the phone for 2 hours every single week with our property management company. And we will be until we sell the property. And then there's more time when we have to file the taxes, and there's a ton of time we got to spend when we refi it, right? It's not passive. If you're in the business of actively investing in multifamily, you are running a business. It's not an investment, it's a business that needs to be considered and thought of as such. So I thought that real estate was a little bit more passive when I get into it, right? Passive income, right? That's what the internet tells you. And then you get into it and you're like, oh, geez, even if I have all these systems and processes in place, I still got to be pretty involved.
Yeah, I've come to realize that as well, as we're on asset management for the different properties that we're on. And so exactly like you said, being on those meetings with the property management company, making sure that renovation is on time and budget, that lease up is going according to plan, where are the rents at. I think a lot of passive investors, they're not sure what happens in the in-between time. And a lot of active investors are just like, as long as I close. Well, it's not the end of the story. Like,
no.
Especially if you're doing your first deal, you may not know any better, right? You're like,
yeah.
Woo, okay, all the fireworks go off and everybody's happy. And it's like, no, you're not done yet. you just started what is a 5-year, 3-year business plan, whatever the case may be.
Exactly. Yeah. And if you think about how many hours does it take to go from contract to close, I don't know. It depends on how complex the deal is. 40 hours, like, I don't know, 50 hours, right? In terms of your time commitment, how many hours does it take to get from close to sale? Hundreds and hundreds of hours. So yeah, simple math will tell you that that is not the case. The work is not done when you close by any means.
Absolutely. All right. And the final question, what does success look like to you?
I think that for me, it changes, right? It's something that's ever evolving. But I think right now, just growth over just personal growth, right? Being better today than I was yesterday, improving the capacity of what I feel like I'm capable of, and ultimately just fulfilling my potential. I'm pretty scared of getting to older age, however that's defined, and being like, I didn't really go as hard as I could have when I had the time, the opportunity, and the freedom to do so. So for me, it's trying to mitigate the regrets of older Axel, but and then in the interim, it's like, how can I sharpen the knife and improve what I'm doing on a daily basis in the short term, in the micro, so that in the macro, I look back and I'm like, wow, really accomplished quite a bit. But I'm sure it'll change when kids come and life changes a little bit, right? That's probably going to become the definition of success, is spending a ton of time with them. But right now, that's what's driving me.
Yeah, you're right. And it goes back to what you were saying, that definition of success, it's ever changing, right? It's not static. It starts as something, you reevaluate where you're at in life with your goals, and then it can adjust ever so slightly. And then, just like you said, as soon as you have kids, it gets completely thrown out the window and rearranged. As I can attest, I have a 4 and a 7-year-old. So now, obviously, a lot of the focus goes to them, and also to that regret piece that you're talking about. In 5 years, what will I have regretted? Will it be not spending enough time in my business to I have the financial resources to give my kids what I want? Or is it not having spent more time with them when they were young, and now that they're 16, they're too cool for me? So all these things you have to weigh in your mind, and that's why I say it can be fluid sometimes, but it's like you're doing a pretty good job if the idea of success is growth, because it sounds like you've done a lot of big things in a relatively short amount of time. So congratulations on that.
No, I appreciate that. And I think we all have to love the game, right? We all have to love the process, the game, the getting in there and the doing it. And I really do enjoy it. So for me, it doesn't really feel like I'm sacrificing for like success. You know what I mean? It's just like, I just enjoy doing this every day. And I enjoy being better tomorrow than I was today. So I look forward for the existential, like, hey, this is really why I'm doing it. But until then, this is what I tell myself.
There you go. All right. Well, hey, Axel, this has been great. Please tell our guests how they can get a hold of you, and if there's anything else that you'd like to share with them.
Sure. So our business is Aligned Real Estate Partners, as you mentioned, alignedrep.com/invest if you want to get on our communications list, see our deals, see our newsletter, all that fun stuff. And then I also host the Multifamily Wealth podcast, just getting really tactical and with all kinds of multifamily investors, talking about how they built and scaled their business. And if you just want to reach out to me, Axel, AXEL, at alignedrep.com.
All right. Well, we'll definitely have all that information in the show notes for our listeners. I appreciate you coming on, Axel, and I look forward to seeing you do big things on your journey to multifamily millions.
Awesome. Thanks, Tim. Appreciate it.
Thank you.